Alright guys, so this video is probably going to be one of the best videos that I've ever uploaded on this channel. I will teach you a couple of things in this video, and to me this is actually the most important video that you will ever watch, I think, on YouTube. Because in this video I will teach you a couple of things. First of all, I'll teach you how to identify valid liquidity points, so you will be able to identify valid liquidity highs and lows. Because the thing is, if you consider every high and low as a liquidity level, then it just won't work, right? Because let's say if you start shorting at every high and then you start longing at every low, it doesn't make sense because you will lose. I will teach you how to identify valid liquidity highs and lows, and I will also teach you how you can find your daily, weekly, or intraday bias with this method. And I will also teach you a model based around this strategy, based around this concept, my bad. So let's start with the video. All right, so what are a valid liquidity highs and lows? So to simply put, right, every single high or low that is formed inside a fair value gap is considered to be a valid liquidity level. So let's assume that this high was formed inside an old fair value gap. So price goes up, creates a high, and then pulls back, gives you a valid high. Now that high in the future is going to be rated, right? So this high, this liquidity level is going to be rated, okay? So keep that in mind. Now let's say that price comes back into this fair value gap and creates a low. So we have a low that is formed in the fair value gap, and then we have a high that is formed inside the fair value gap. Now this low and this high is a valid liquidity swing points, right? So this low is a valid liquidity swing point and this high is a valid liquidity swing point. So now you can anticipate that price is either going to take out the high that is formed in the fair value gap or the low that is formed inside the fair value gap. So now how do you basically find the daily bias or your weekly bias or your intraday bias with this method? So let's assume that we have a high and low in the fair value gap, right? Now you are waiting for either for price to take out the high that was formed inside the fair value gap or the low that was formed inside the fair value gap. So let's assume that price takes out the high that was formed inside the fair value gap. Now once it does that, let's assume that this high and low is on the daily time frame. Now once price takes out the high, right, that was formed inside the fair value gap, you will drop down to 1 hour time frame, and then you would look for a market structure shift. Once you have a market structure shift on the 1 hour time frame, you can then anticipate now price is going to run the low that was formed inside the fair value gap. Very simple, and this is the whole model, guys, that you can use by its own. So I'll repeat it one last time. A high that is formed inside the fair value gap and the low that is formed inside the fair value gap is a valid liquidity levels, okay? Now once price takes out the high or the low, you are simply looking for a market structure shift on the lower time frame. So for the weekly time frame, you would drop down to 4 hour time frame to look for a market structure shift. For the daily time frame, you would drop down to 1 hour time frame to look for a market structure shift that would confirm that the price is now going to rate the other side of the bias of the liquidity, all right? And for the 4 hour time frame, you would drop down to 50 minutes time frame to look for a market structure shift. So this is a bearish example. You can see we created a low in the fair value gap and then we created a high inside the fair value gap. Now price comes back, rates the low that was formed inside the fair value gap. Then you will look for a market structure shift, take your entry, and you will look to target this level. This would be your draw on liquidity, because price is always going to do that, okay? It's going to move from the low that was formed inside the fair value gap to the high that was formed inside the fair value gap, or the high formed inside the fair value gap to the low formed inside the fair value gap. Okay, so let me give you guys a couple of examples. So in this example, you can see that we have a fair value gap over here, right? And then price comes into this fair value gap and creates this high over here. If I zoom in a bit, you can see we have a high here, actually equal highs over here, and then price pulls back, comes back, and then right after price rated the high over here, if I zoom in a bit here, you can see inside this fair value gap, we created this low over here. So once price took out the high over here, what would be the ideal situation from there? You would look for a market structure shift, and then you would look to target this low that was formed inside here. So this level would be your draw on liquidity. And this is very, very accurate, guys. Trust me on this, okay? Because this is how you can find your daily bias. You can use it as a model. You can use this to identify your draw on liquidity. Very impactful concept. Here is another example, Bitcoin on the daily time frame. So you can see we have this fair value gap over here, and inside this fair value gap we created this low, right? This low didn't violate the first candle of the fair value gap, so that is inside the fair value gap. So this low is our liquidity point. Now over here, if you can see, we have this big fair value gap, okay? So in this big fair value gap, what did we create? We created this high over here, right? Once we created this high over here inside this fair value gap, we went ahead and took out the low that was formed inside here. So now once price takes out the low here, what would be your ideal draw on liquidity? It is going to be the high that was formed inside the fair value gap, guys. Very simple, guys. We move from the lows that was formed in the fair value gap to the highs that were formed in the fair value gap, and vice versa. So you can see we took out this level, and I believe in the future we're going to take out this high because that was also formed inside the fair value gap. Here is another example. So you can see we have a fair value gap, right? Price comes back into this fair value gap, and we created this high over here. As I zoom in, you can see that. Now over here, you can see we have another fair value gap, and price came back and created this low here. Now we are either waiting for price to take out the buy side or the sell side, right? So over here, we have the high that was formed inside the fair value gap. Price goes up, takes out the high. Now we would look for a market structure shift on a lower time frame, and you can see price comes back and takes out the low that was formed right inside the fair value gap. Very simple, guys. Let's move on to the next example here. So you can see we have a fair value gap inside here, and then we have a high that was formed inside this fair value gap. So that is a valid liquidity point. Now if I zoom in a bit, you can see we have this tiny little fair value gap, and price created a low inside this fair value gap. So now what happens? Price comes back and it raids the low. So now your next draw on liquidity is going to be the high that was formed inside the fair value gap. One more thing, instead of looking at fair value gap, you can also look at volume imbalances. So if you don't know about what are volume imbalances, you can just search it up on YouTube. I would not look for these on auto blocks because that is not somewhat accurate, but fair value gaps are the most accurate, and then you can look for volume imbalances. So you can see we took out the low and we went up and took out the high over here. Here is another example. So you can see we have this fair value gap. This was the high that was engineered right by market makers. Price comes back, and over here you can see we created a fair value gap. Price tapped into this fair value gap and created a low over here. Now what price did, it went back up and it rated the high that was formed inside the fair value gap, right? Now once price rated this level, we look for a market structure shift, and once it confirmed the market structure shift, we would then target this level. And as you can see, price came down and took this level. One key note to think, once the high in the fair value gap is rated, we would just forget about that fair value gap. Okay, so this high was formed, right? If it gets rated, then that fair value gap is of no use. So you would stop looking for highs and lows in that fair value gap because the low or high that was already formed in the fair value gap was rated. So very simple concept, guys. There's another complicated example here. So you can see that we have this big fair value gap, right? And in this big fair value gap, you can see we created this low here, and there's a tiny fair value gap over here. So in this fair value gap, you can see we went up and created this high over here. Note that this high didn't breach the high of the first candle of the fair value gap. So that is still inside the fair value gap. Now what happens is price, it takes out the high that was formed inside the fair value gap. Now our draw on liquidity is going to be the low that was formed inside this fair value gap. Very simple, guys. Here is another example, and this would be the last example. Then we'll move on to the market structure shift example. So over here, you can see that we have a fair value gap, right? So we created this high in this fair value gap. Now, if you look at it here, there's another fair value gap, right? And price created this low in this fair value gap. Price goes up, reads the high that was formed inside the fair value gap, gives you a market structure shift, and then you would simply target the low, which was rated by this candle over here. So that is pretty much how you can actually look for valid liquidity points, guys. You can actually try to find your daily bias, monthly bias, weekly bias, even intraday bias, and you can also use it as a model itself, as a strategy itself. Let me give you guys one example on how it would look when you get a market structure shift and then you take your entry. All right, guys, so let's look at the example here for the market structure shift. So as you can see that over here we have the high and we have the low, that is our draw on liquidity, and we have taken out the high, right? So now once price takes out the high, we would drop down. Since we are on the daily, we would drop down to 1 hour time frame. Now over here with this right line, you can see we took out this level, and then we would look for a market structure shift. So price comes back below, gives us a market structure shift. It takes out this low, right, giving us a market structure shift. And as you can see, we have a fair value gap over here. This would be your entry point. You would put your stop right above the high, and then you would simply look to target the liquidity level, which was right here. Of course, I wouldn't recommend that you hold your trade till the original draw on liquidity. I would say just target the closest level, because that way you're just making sure that nothing happens, because you cannot trust the market 100% of the time. Anything can happen, right? But as you can see that the main draw on liquidity was hit. Thank you so much for watching, guys. If you did enjoy this video, if you found this video helpful, please hit that subscribe button and let's get to 100K subscribers. I'll see you guys in the next video. Goodbye. Mwah.